we live in such a hyper-connected world these days that we should not underestimate the speed at which confidence in a currency can evaporate.
Well, that's the point, right? I mean, look at Silicon Valley Bank. 1 week it was solvent. Some things happened.
Yeah.
Word spread. $42 trillion got withdrawn in 1 day. And a week later, it was bankrupt. I'm not suggesting that will happen with the dollar or with the U.S. currency, but things can happen quickly.
Yeah.
If people come to realize that the government can never stop printing money and that this yield curve control is in place and the QE is going to get larger and larger, they're going to say to themselves, if I have savings, I need to put those savings into something the government can't print. And they really only have two choices, gold and Bitcoin. When that occurs, the government would be in a position where they couldn't actually deficit spend because they couldn't print.
They would basically have to be financially responsible.
They would force them into financial responsibility because if they didn't have the tax revenue, they wouldn't have the ability to spend it. Or if they did spend it and printed to spend it, that exchange ratio would change very substantially. And then eventually, if it changed enough, Gresham's law will kick in and people will abandon the dollar. We had a bubble in technology and then the dot-coms, it burst. And of course, dot-coms went on to grow and become much bigger part of the economy. We turned that into a bubble in housing and in the banking system related to housing. And of course, that was bailed out.
Yeah.
Okay, so we had a banking crisis. I get it. You had to take interest rates to zero. Okay, now the banking crisis is over. How about we take interest rates back up? No. They left them low for 7 years. And what that did was it blew a bubble in everything. It blew a bubble in stocks. It blew a bubble in assets. It blew a bubble in housing. It blew a bubble, in inflation now. And so, all of these values are fake based on all that free money that was created, which was an enormous distortion. And now we have a bubble at the level of the sovereign currency. And there's no level above this. I mean, when you're dealing with a sovereign currency, it's not like there's a galactic, bubble that we can build on Mars. We are at the highest level, which is the currency. And when this bubble bursts, the currency's at risk.
Welcome back to another episode of Cypherpunk'd. I'm joined today by my good friend Larry Lepard. We're going to be discussing his book, The Big Print, and this is episode 7. We're going to skip ahead a little bit and go to chapter 22 and 23. That way we can talk more about the problem before we get to talk about our favorite thing in the whole world, which
the solution.
The solution to the problem, right?
Yeah.
So chapter 22, which is the roadmap for the next decade.
Yeah.
Here you write, applying the fourth turning model, we can estimate that a resolution to this crisis will likely manifest between 2028 and 2033. Historically, these periods of significant tumultuous change tend to last between 15 and 25 years, maybe 20 on average. This is really interesting. Not many people will put an actual time span on this, and I think even if you're wrong on your actual dates,
I will be wrong.
Yeah, I mean, it's impossible to predict the future,
yes,
right?
But I will be wrong. But I'm trying to build a model.
Yeah, no doubt, right? And what my favorite saying is, all models are wrong, but some are useful, right? So I think that whether this is 2038 or 2030, whatever year it actually we kind of really have this this big event happen, I think it's inevitable that. Something is coming here in the future. You wrote here that there is no level above this bubble. I was going to ask you, what exactly does that mean?
Well, let's just look at the prior bubbles that we had. So we had a bubble in technology and then the dot-coms, it burst. And of course, dot-coms went on to grow and become, much bigger part of the economy. We turned that into a bubble in housing and in the banking system related to housing. And of course, that was bailed out. And now we have a bubble at the level of the sovereign currency because they took interest rates to zero for a very long time. We haven't talked about this, but going from doing ZIRP and doing it from 2008 all the way to 2015, I mean, the crisis was over in a year or two.
Yeah.
Right? Very much like the spending that the federal government has done post-COVID. You would think it would go back to normal, right?
Yeah.
Okay, so we had a banking crisis. I get it. You had to take interest rates to zero. Okay, now the banking crisis is over. How about we take interest rates back up? No. They left them low for 7 years. And so what that did was it blew a bubble in everything. It blew a bubble in stocks. It blew a bubble in assets. It blew a bubble in housing. It blew a bubble, in inflation now. And so, all of these values are fake based on all that free money that was created, which was an enormous distortion. And there's no level above this. I mean, when you're dealing with a sovereign currency, it's not like there's a galactic bubble that we can build on Mars. We are at the highest level, which is the currency. And when this bubble bursts, the currency's at risk.
Yeah.
Right? That's the point I'm trying to make there.
No, I think it's a great point. It reminds me of this famous quote that's like, markets can remain irrational much longer than you can.
Well, that's right. That's right.
So
and it could keep going for a while.
Yeah.
And you've made that point, and I don't disagree with that.
Yeah.
I do not disagree with that. But I'm taking my Ruthian shot, and I'm saying, okay, this is it right here. We're going to put the ball right there, just because. And I say that just based on historical precedent. I mean, things like the Hirschman chart that shows when countries get to this level, it generally results in a crisis.
You're making a very educated calculation.
That's right. I'm making an educated guess.
Yeah, which that's all you can do, right?
Right.
You have this information, and you put all the pieces.
I don't know it
together
for sure, no doubt.
History again, like said in your book, right? It often it rarely repeats, but it often rhymes, right?
Well, and I should point out, just so that people have full disclosure, I thought this was going to happen in 2008.
Yeah.
Okay. I thought we were going to have massive inflation, hyperinflation in 2008, and I was totally wrong.
Yeah.
They changed the rules. They did a lot of things.
That's what I'm saying. Like they're pulling on all these little wizardry.
Well, and that's the counter argument to my argument that they'll figure out some way to manage through this.
I think your argument is still directionally right, regardless. It's just
when
a matter exactly right. It's like when.
Yeah.
It's the famous question.
Yeah, it's hard.
It was like even in the Big Print, or I'm sorry, not the Big Print, but the Big Short, right? The movie.
Well, that's right.
The guy he knew what was happening. He's like, what the hell? How can this keep going?
But he suffered. I mean, remember in 05 and 06, and the marks were going against him, even though everything was collapsing. It was a long time.
Yeah. And I think that
he was ultimately very right.
The most powerful empire in all of human history, and in America, essentially. That this whole game, this musical chair, this game can be played for a while. So we'll see what happens. Right?
Yeah, that's right.
This term ceteris paribus, I've seen that before, but you defined it.
It means all things being equal.
All things being equal. Yeah. As interest rates climb due to increased bond sales and waning demand, the U.S. government will find itself ensnared in a debt spiral, with escalating interest expenses driving larger deficits and necessitating the sale of even more bonds. This is the debt spiral, the debt doom loop that we described earlier and talked about. So this is not new or unusual. We've seen this many, many times. I think you pointed out here the larger countries that succumb to this, right? Like all the small ones, Zimbabwe, Venezuela, Argentina. We've kind of seen this,
We've seen it lots of times.
We've seen it.
This is not
even I've seen it growing up.
Yes, right.
But I was not around for Weimar Germany or Russia.
Nor was I. Nor was I.
You throw that in there. I wasn't there for those ones. China, Brazil. So you did kind of mention this yield curve control a little bit earlier, but here you say it's financial repression. What do you mean by that?
Well, so the first signs of this currency failure will be people and investors saying, they're going to have to print a lot of money. They're going to debase it. I don't want to own these bonds anymore.
Yeah.
And so they will go to the market and they will sell the bonds. By selling the bonds, that'll make interest rates higher, which will make the deficits worse. And this is the interesting point we should make here. This level of debt to GDP, the United States had this coming out of World War II.
Yeah. That was the last time they did this.
This is the last time they did this. But we made it through it. And the way they made it through it was with yield curve control. They basically made the decision and said, you know what, we're going to screw bondholders because we're going to hold interest rates artificially low, and we're going to let inflation run really hot. And then we're going to try and get productivity growth in terms of cars, appliances, and housing. And it worked. They kind of slowly but surely through the 50s, they climbed out of it, and the GDP grew a lot and debt didn't increase because there wasn't a war going on. The difference now is debt is consistently increasing and we're spending a lot more than we're bringing in, so we'd have to change that. And the yield curve control piece of it, we haven't done yet, but I think they will be forced to do it because I think the bond market is eventually going to say, hey, no mas, guys. You're inflating this currency like crazy. Why should I own a piece of paper that only pays me 4%? And of course, if interest rates today went to 10% or 15% or 20% like Volcker did, in the last inflationary episode, Paul Volcker took rates to 20%. He could do that because debt to GDP was only 34%.
Yeah, you can't do that anymore.
Can't do that anymore.
Everything would instantly collapse.
If we went to 20% interest rates,
that's like $5 trillion a year in interest expense.
Yeah, everyone would go bankrupt.
Yeah.
Just instantly, including the U.S. government. So that's impossible. But I guess the point is, to your point of how do they stretch it out longer? They do yield curve control. And what does that mean? It means they say, we're going to cap the 10-year at 3%, and we're going to cap the short bonds at 1%. And the bond market is going to say, oh, okay, you're capping them there. That's all I can get. I don't want that. Sold to you. And the Federal Reserve is going to say, okay, you want to sell that bond to me? Fine. I'm going to print more money, QE, to do it. Now, here's the thing that gets interesting. Think of the math. The Fed balance sheet right now is $6.7 trillion. The bond market is $36 trillion.
Wow.
Okay. So let's say they say we are going to yield curve control. We're going to cap the 10-year at 3%. Some piece of that $36 trillion is going to go, there's going to be a lot of inflation.
Yeah.
3%, I'm not interested.
Yeah.
Sold to you, Mr. Fed. Mm-hmm. Well, if Mr. Fed has to buy even half of the outstanding bond market, their $6.7 trillion balance sheet is going to increase by 18.
Yeah, that gets you over that $20 trillion prediction. Yeah.
Right. Which then
it's just math.
Well, exactly. And that increase leads to an increase in money supply of a similar volume, which then, of course, leads to an increase in inflation of a similar volume. Do you see where I'm going with all this?
Yeah.
And so this is how we get to a mass Gresham's law event, and it's probably a good time to define that. I mean, Sir Gresham was a gentleman who was the exchequer for Queen Elizabeth back in Britain in the 1600s, and what he observed is that when there were two monies operating in a system, the people would tend to spend the money that they knew was losing value and hold on to the money that they knew was retaining its value. And then back in those days, of course, it was printed money versus gold or silver versus gold. They would spend the silver and hoard the gold because the gold was holding value better than the silver. And so, this could happen here where if people come to realize that the government can never stop printing money and that this yield curve control is in place and the QE is going to get larger and larger, they're going to say to themselves, if I have savings, I need to put those savings into something the government can't print. And they really only have two choices, gold and Bitcoin.
Yeah,
because the government can't print gold, the government can't print Bitcoin. And so what that would mean, and
people like you and me already do this.
People, of course we do. But what that would mean is that in dollar terms, the price of gold and Bitcoin would go up substantially. And I actually even have two charts in the book that show this, that this has already started. Since COVID, gold is up 200% in U.S. bond terms, and Bitcoin is up 2,000% in U.S. bond terms. So what I'm trying to point out here, what I'm trying to suggest is this process has started.
Yeah.
It's already started. And so all we're waiting for now is for the rest of it to play out.
One thing I wanted to talk about is this idea of a monetary reset. You write here, a monetary reset is somewhat akin to a debt jubilee, rooted in ancient Mesopotamia and biblical tradition. Debts were forgiven or canceled on a large scale every 50 years. I think that's an interesting.
Yeah, it is interesting. I mean, if you read the history of the Bible and the history of the times, I mean, in debt-based systems over time, the debts get so large that the slaves and other people just can't pay them.
Yeah.
And they declare a jubilee. Debts are all forgiven. Everyone starts off with a clean slate again. Obviously the debtors, the people who own the debt, who think they're going to get repaid, they're enormous losers in that case. But
I think they'll be all right. Well, if you look at the 1971, what the fuck happened in 1971 chart?
That's exactly right. And more importantly, look, what I'm describing here is painful for somebody no matter what, because the system is broken.
Yeah.
But what I'm also describing here is after the change, we are back in a sound money standard and things get much better.
If we go back to a sound money, yeah.
Yes, if we do. Yeah.
Which
I think
I can't see another.
I think by definition we would have to, because people would realize that it was the money that caused the problem and they would demand sound money.
Yeah, no doubt. Wow. The tinder has been lit, but the fire could take a while to develop. That's what I think.
Yeah, you're right.
I like that. That's interesting way to look at it.
You're right.
But as a token of the same coin, and you kind of mentioned Silicon Valley Bank here, I was thinking the same thing. We live in such a hyper-connected world these days that, we should not underestimate the speed at which confidence in a currency can evaporate.
Well, that's the point, right? I mean, look at Silicon Valley Bank. One week it was solvent. Some things happened.
Yeah.
Word spread. $46 trillion or $42 trillion got withdrawn in one day. And a week later, it was bankrupt. I'm not suggesting that will happen with the dollar or with the U.S. currency, but things can happen quickly.
Yeah. I mean, I hope it doesn't, because that would really hurt a lot of people, sadly. So
it'd crush a lot of people.
Yeah. Something I learned that you have in your notes here is something called Thier's Law.
Oh, yeah.
I had never heard of that before. So it's complementary to Gresham's Law.
Yeah, it's kind of the opposite of Gresham's Law. I mean, eventually, once Gresham's Law runs to its natural conclusion, then what was a very spendable currency becomes worthless, which is to say the dollar becomes worthless. And then Thayer's law kicks in where you have to spend the sound money because there is
nobody will accept anything else.
Nobody will accept anyone else, anything else. It's kind of the opposite of it.
I guess the key turning point on that is when the legal tender laws can no longer be enforced in free markets, people naturally prefer to transact in stronger currencies, leading to the abandonment of weaker ones. And examples include Zimbabwe and Venezuela, where citizens instinctively dollarize their economies during periods of extreme inflation, favoring U.S. dollars over collapsing national currencies.
Exactly. And I mean, you see in Venezuela, the bills were just in the street. I mean, people were burning them for fires because it was worthless.
God, I think it was the Bitcoin conference in Miami in like 2020 or 2019 or one of those years.
Did you see giving out the bills?
Yeah, no, they had. I have got a bunch of 100,000 or $100 billion.
Yeah, no, I've got a Zimbabwe. I think I have $100 trillion Zimbabwe dollars. I keep that pinned up over my desk.
Yeah, they've got. They had this giant dumpster at the Bitcoin conference. I think it was 2019. It was 2020, one of those years. But in the dumpster was just all of this Venezuelan bolivars. And I think there was like a fan blowing on it, and it would kind of like blow everywhere.
Yeah, it's all just worthless.
Yeah, so I guess wild. It's hard to believe that. Was it the Voltaire quote, which is fiat money always returns back to its intrinsic value. Zero. Yeah.
As Nathan Lewis said, fiat money is monopoly money.
Yeah. Can you define hyperinflation? You had an interesting definition here that I had.
Yeah, there's I don't remember the name of the guy who's
Philip Kagan.
Yeah, Kagan defined it in the 50s. It's defined as inflation of over 50% a month in prices. So it's pretty damn high. I mean, you can have high inflation that's not hyperinflation. I mean, the Southern American economies, a lot of them have had 10, 15, 20% a year annualized rates of inflation. When it goes over 50% a month, it means you're really in a currency failure event. I mean, and that's kind of, I think he coined that definition, and most people have come to accept that as the definition. Usually once you get into that, you just can't get out. I mean, currency is going to go to worthlessness.
Yeah, I mean, hopefully we never.
Hopefully we never.
I hope we find a solution to without that.
I believe we will. I think we'll get to a very high inflation environment. I think people will be screaming, and I think there'll be a political movement to return to sound money.
Yeah.
That's what I hope for.
I have one of our listeners. He constantly talks about John Nash having this idea to have his ideal money, where he talks about some ideas to make fiat money non-inflationary. But I always go back to the idea that governments just can't be trusted. Like it's just impossible. They'll always find a way to abuse it, right? Yeah. Until you separate money and state, I don't see how it's possible.
I kind of agree.
Although John Nash was absolutely brilliant, game theorist and mathematician. So it's an interesting thought.
I mean, maybe if you made it punishable by death, I mean,
which we did at one point, right? It was.
Yeah, no, I get
punishable by death, but they found a way. They found a way over a century. They
figured it out.
They eroded it,
and nobody got killed.
Yeah, exactly. You have a list of all these countries. People think that this is this can't happen here and it's rare, but if you look at history, this is the rule, not the exception. It
is. I mean, I think I remember seeing a study that said the average life of a fiat currency was like 43 years.
I think it was like 71, but I could be wrong. It could be closer to 43.
It's in the 40s, I'm pretty sure. And
Paul, can you pull that up on Grok? What is the average lifespan of a fiat currency?
Yeah, and so if you consider this one,
what? No, it's less than 100 for sure. It's either 7. I thought it was 70.
Here we are in the 54th year of this experiment. If you started in,
they tend to last around 27 to 100.
Well, insert fiat.
Yeah.
Tend to last 27 to 100. That's a pretty damn big range.
That's a big range, but
on an average.
Yeah.
I recall reading a study that said they tend to last about 40.
Yeah. Gotta come
I'm sorry. Yeah.
Got to hear you.
Yeah.
It says approximately 27 years. No, I don't know. Somewhere in there, but less than 100
more stable ones. Well, the British pound has never
the longest one,
and it's the longest living one right now.
It's only lost 99.9%.
I was going to say it's been massively devalued, but it still exists. It's still a British pound.
Yeah. So that's the one exception to the rule. From my research.
Yeah.
But for high inflation to morph into hyperinflation, a series of policy errors and a complete loss of public confidence in the currency would have to occur. So that's an interesting thought there.
Yeah, I mean, it has to be almost a policy decision. I mean, and this is where Kelton and the MMT people could take that decision. I think the people running the Fed now, I mean, I know that Powell has been asked about MMT and Kelton and others, Larry Summers, and other people in the Keynesian model have been asked about, and they know that MMT is bullshit.
Yeah.
So nobody in the existing establishment, as far as I can tell, would support MMT, but that could change.
So a better policy alternative and more likely scenario includes structured high inflation or a monetary reset / debt jubilee. In essence, the dollar would be devalued against real assets in a controlled manner to avoid the chaos of disorderly hyperinflation.
Right.
The key is to avoid war and destruction. A monetary conference, followed by a reset or structured devaluation, would be a much more orderly choice. Once a country returns to sound money, it can rebuild quickly from a solid foundation. What would that actually look like? A monetary reset? Like we'd have a Bretton Woods style conference and then just come out and say how?
Yeah, I mean it would be. I mean, an example it would be something like if the U.S. government were to say, we are going to peg the dollar to gold and Bitcoin, and the U.S. government will be a buyer and seller of gold and Bitcoin at the following prices to start with, but we're going to let the market determine the long run numbers.
Yeah. Okay.
And if you bring us an ounce of gold, we'll give you $30,000. And if you want to give us $30,000, we'll give you an ounce of gold. I'm just picking a number that might work.
Yeah.
And in turn, at Bitcoin, we're going to say Bitcoin's worth $1 million a coin. If you want to give us one Bitcoin, we're going to give you $1 million. And in turn, if it falls below that, we'll be buying Bitcoin. I mean, they basically would peg the dollar to these two currencies. My sense is that what would happen over time is natural levels would be found based on the management of the dollar, and perhaps ultimately people would be transacting in Bitcoin and gold. Not obviously transferring gold around, but electronically transferring gold around, and these would be the base layer of the monetary system.
Gotcha.
And then when that occurs, the government would be in a position where they couldn't actually deficit spend because they couldn't print.
Yeah, they would basically have to be financially responsible.
They would force them into financial responsibility, because if they didn't have the tax revenue, they wouldn't have the ability to spend it. Or if they did spend it and printed to spend it, that exchange ratio would change very substantially. And then eventually, if it changed enough, Gresham's law will kick in and people will abandon the dollar.
Yeah. Okay. Interesting. This takes us to the famous quote: "One who panics first panics best."
Yeah.
So, I've never lived through a situation like that. So, basically, if the market price of Bitcoin right now is 95,000, let's say it's 97, 90, 100,000, and then they said that the government said, "Hey, we're going to revalue, and now we'll give you $1 million if you send a Bitcoin."
Right.
Would the rational thing to do would be to just immediately go and send a Bitcoin and get?
I don't know. I mean, I think I'd probably wait and see how the dust settles.
Yeah.
I mean, $1 million might be too low.
Yeah, I think long term, absolutely.
Right.
But I guess in the short term, would the market immediately spike up and then try to find that parity?
It certainly would spike up a lot, because I mean, if for example, if the government said, "I'm willing to give you $1 million for every Bitcoin you give me," if you and I exchanging, I mean, if I were willing to sell you a Bitcoin for $900,000, you would buy it and turn around and give it to the government.
That's what I was thinking.
And make $100,000 profit.
That's what I was thinking.
Yeah. No, the price would go to that level.
Yeah, gotcha.
But what you don't know is where it would go from there.
Yeah.
And what you also don't know is the relevance of the dollar, and you don't know what all the other prices would do.
Yeah.
I mean, the good news about that kind of a thing is, yes, okay, suddenly your gold is more valuable and your Bitcoin is more valuable, and the people who own those are much wealthier. But in turn, the other thing that might happen is with that kind of a reset, I mean, you've just massively devalued the dollar. So now what's the price of oil? I mean, it used to be, $60 a barrel. Since we've just massively devalued the dollar against these other two sound money currencies, maybe oil is now, $1,000 a barrel.
Yeah.
And gasoline is higher in price. I mean, it's all the prices would reset around the new monetary standard, which is Bitcoin or gold.
Yeah.
Right?
Yeah, no doubt. Here you've got you have some introspection. I'm going to read what you wrote.
Yeah.
I have been terribly early and wrong in thinking the monetary system is coming apart. However, what I am describing could happen rapidly, and when it does, there will not be a do-over. You will either hold sound assets or not.
That's true, and I do believe that. I mean, this is back to the Silicon Valley Bank example. I mean, when things start to move, they can move quickly, and I think one of the errors that a lot of people will make too, there'll be people who own Bitcoin and the Bitcoin will double and they'll think, "Oh, this is really great. I should take a profit."
Yeah.
What they don't realize is that Bitcoin's about to go up 10x.
Yeah, they're missing the forest for the trees, right?
Exactly.
The tree Bitcoin has like so many people. There's a famous little Bitcoin mini series. I can't remember. I want to say it's called Bitcoin and Me or something like that. And it's like this little cartoon, and it kind of talks about Satoshi in the early days, and it's kind of funny. But like I think the first or second episode, it gets to this point, and I think it's either it's like Hal Finney had a computer like paralyzed or something like that, and someone in the episode just says something like, "Hey, how will I know when to sell my Bitcoin?" And he kind of turns around and said, like, and close out the episode, he goes, "You know, when you're ready to sell your Bitcoin, you won't have to."
Well, I think that's right.
Yeah,
borrow against it. Yeah, I mean and also Neo in the Matrix. You know, that's the whole point. Neo, you won't need to.
Yeah, exactly.
Yeah.
I think that's a nice way to look at it. So what did you get wrong here when they before it looks like you underestimated the Fed's capacity to manipulate the system in ways that defied conventional logic?
Yeah,
which is kind of what I'm saying. Like
Yeah, no, they'll change the rules again.
Yeah.
Well, in 2008, what they did was they figured out a way to sterilize all the money growth that they were creating, and that was by paying interest on excess reserves. And so that was a rules change done by the Fed that I didn't understand and pick up on. And that rules change prevented consumer inflation from really raging. And I thought we would have raging inflation, which would lead to hyperinflation, the failure of the dollar. And I was wrong about all that, totally wrong, based on, this, I think I said in the book, never underestimate your enemy, right?
Yeah.
I mean, they figured out a way to keep the money in the system and to use it to inflate assets, not goods prices. If they had
clever.
They're very clever. If they hadn't done that, it would have gone into the banks. If the banks had it, they would have lent it out. If they lent it out, it would have caused growth. If that growth had taken place, there would have been inflation related to it.
I think it's fascinating how they did this. You wrote here, during the Great Financial Crisis, the Fed modified the Federal Reserve Act as a part of the Economic Stabilization Act of 2008 and implemented a subtle but powerful change, paying interest on excess reserves, IOER, another one of their little programs. This program effectively bribed banks to keep the money parked at the Fed rather than lending it out. It was a blatant subsidy to the banks. The result? The anticipated wave of consumer price inflation never materialized. Instead, ZIRP fueled a credit-driven asset bubble, inflating equities and bonds rather than consumer goods. It created what we now call the everything bubble.
Yeah.
Cheap money helped asset prices soar. So this, again, further exacerbates the wealth inequality as those who have access to
the average
quintillionaires can
the average
assets
the average person can't borrow money cheap, and maybe the only assets they have are their house.
Oh, there you go. Exactly. Here you wrote, like putting out a kitchen fire with a blowtorch, the Fed's response to the housing bubble was to inflate an even bigger one, engulfing every asset class in sight. Wow. Yeah. So you also wrote here, and you were very honest in this book, which I really respected a lot. And, I was reading this, I felt for you. You're like, I've never felt so ashamed and stupid. Watching my net worth evaporate was not only painful, but deeply humbling. If I had not been so stubborn, I might have changed my strategy. I recall speaking to a very intelligent business school classmate at the time. You might be right, he said, but you're fighting forces much larger than you, forces that will always win. Interesting.
He was certainly right in that round, and he could be right in this round as well. I don't know. We're going to see.
Trying to think of what little acronym.
What are they going to do next, right, Matty?
What acronym are they going to?
We don't know. They got a lot of them. I'm sure they'll figure something out.
Oh man, yeah. I wouldn't underestimate these. They got that army of 40,000 employees.
I think it's safe to say that there's a good chance they'll take a bunch more kicks at the can.
Yeah.
However, I don't think those kicks at the can come without more inflation.
You're 100% right.
Even if we don't have it all collapses, hyperinflation.
Well, you're going to have the big print, no doubt.
Exactly.
Yeah.
We live in an inflationary world. I think that I have a very high confidence level in that prediction.
This last part of the chapter, you talk a little bit about how you got involved in CrossFit and how you kind of stepped away a little bit, where you focus more internally on yourself, which I think is super relevant to being a Bitcoiner. I know we haven't really talked about Bitcoin yet, but I think it's important because it really talks about it's this idea of time preference and thinking about what things matter in the long run. It's the complete opposite of Keynesian economics. It's the complete opposite of in the long run we're all dead.
Yeah.
I
mean, I recognize that even though I lost some wealth and it wasn't working out for me, that that wasn't really the most important thing in my life. The most important thing was my family and my relationships, my health, and And I also wanted to make sure I was around to see. I did believe fundamentally, ultimately, someday I might be right. And I wanted to make sure I was going to be around to see that. And I'd kind of let myself go physically in terms of working out. And when I was younger, I was athletic, worked out quite a bit. But as going through my middle ages with kids and everything else, I kind of let my fitness, deteriorate. And I thought, well, if I want to be around, and to win this thing, I got to be healthy. So I really got serious about, health, and that drove me into CrossFit, which is a very extreme health program. I mean, if you're not careful, you can hurt yourself doing it. So I encourage people to make sure they have good coaches and be careful. But if you're careful, it really works. I mean, you can get really fit really quickly doing CrossFit.
You mentioned one of your favorite songs here, and I also love this song.
Yeah.
I Won't Back Down by Tom Petty.
Yeah.
I'm going to have Paul just cue us out with that song as we close out this episode. And I'll close this out here with what you put at the very end of your chapter. Sound money will win.
I believe it will.
I also believe that.